Every analyst on Wall Street is asking the wrong question. They are debating NVIDIA's PE ratio, they are analyzing new AI models, they are arguing about competition from AMD. They are all missing the five-alarm fire burning right under the entire market. The most advanced technology in human history is being by a 100-year-old electrical grid that is officially at its breaking point. This isn't a future problem. Verifiable data from U.S. utility companies proves the power crisis is already here, and it is about to trigger the most brutal and unexpected portfolio rotation you will see in your lifetime. This is the story happening behind the headlines, the one that explains why the smart money is quietly selling the digital dream and buying the gritty, physical reality. And by the end of this video, I will show you the exact roadmap they are using. Let's begin with the context, the what that is unfolding right now, using hard numbers, not narrative. We are not talking about forecasts. We are talking about facts on the ground reflected in legally mandated public filings. First, let's go to the Southeast. In its 2025 Integrated Resource Plan, Georgia Power, a subsidiary of Southern Company, stated its high-demand forecast for the next decade has increased by a staggering 17-fold from its previous year's plan. This isn't a typo. A 1,600% increase in projected demand. Their filing explicitly attributes nearly 80% of this new demand load to one source, data centers. This is not an isolated event. Let's move to the Southwest. Arizona Public Service, APS, the state's largest utility, confirmed in its Q3 2025 earnings call that it now has a queue of over 10 gigawatts of data centers applying for grid connection. To put that number in perspective, the largest nuclear power plant in the United States, Palo Verde, has a capacity of just under 4 gigawatts. Arizona is facing requests for the equivalent of nearly 3 of its largest power source, just from new data centers. The utility's CEO stated bluntly, "We are evaluating all options, but meeting this load in the requested timeframe will be a significant challenge." Now, let's look at the data center capital of the world, Northern Virginia. The regional grid operator, PJM Interconnection, which manages the flow of electricity across 13 states, has had to implement a multi-year pause on new data center connections in parts of Virginia. Their 2025 planning reports show that data centers, which accounted for roughly 10% of the region's peak load just a few years ago, are projected to account for nearly one-third of the total peak load by 2030. This is a system-level strain that is unprecedented. The ground truth is simple. The AI arms race is creating a demand tidal wave that is crashing into a system designed for the 20th century. Now for the deep dive. The why. Why is this the single most important, under-the-radar story in finance today? Because it reveals a fatal mismatch the market has not yet priced in. This is the core analysis that separates the informed investor from the crowd. There are 4 powerful forces at play. First, and most critically, is the physics of lead times. This is the data that should truly alarm you. According to a comprehensive 2024 study by the Lawrence Berkeley National Laboratory, a research center funded by the U.S. Department of Energy, the average time it takes to get a new high-voltage transmission line approved and built in the United States is now over 10 years. This is due to a labyrinth of local, state, and federal permits, including lengthy environmental reviews under the National Environmental Policy Act, NEPA, and frequent "not in my backyard" or NIMBY opposition from landowners. In stark contrast, a hyperscale data center can be designed and built in just 18 to 24 months. The hardware itself is an even bigger problem. A report from the U.S. Department of Energy, titled Large Power Transformer Study, confirmed that the lead time for a new large power transformer, the 400-ton piece of equipment essential for any new grid connection, is now between 2 and 4 years. This is due to a global manufacturing bottleneck and a shortage of a specific material called grain-oriented electrical steel. You cannot solve this problem by printing money. You cannot download a transformer. You cannot get a zoning permit with a software patch. There is a multi-year, unavoidable physical bottleneck between the exponential demand of AI and the linear, bureaucratic reality of our energy infrastructure. This gap guarantees scarcity. Second is the institutional money flow. This is where we stop listening to what Wall Street says on TV and start watching what their largest funds are actually doing. Let's follow the billions. In late 2025, private equity giant Blackstone announced the final close of its infrastructure fund at a record $8.2 billion. The primary target in their investor presentation? Digital infrastructure enablement, which is sophisticated language for the power plants, transmission lines, and pipelines that data centers desperately need. Similarly, KKR & Co. has been aggressively acquiring renewable energy developers not for their green credentials, but for their valuable interconnection rights to the power grid. Even more telling is the action of BlackRock, the world's largest asset manager. Their recent acquisition of Global Infrastructure Partners for over $12 billion wasn't just a purchase. It was a strategic declaration. They understand that in this new era, the entities that own the source of power will have ultimate leverage over the entities that consume it. This is a classic picks and shovels play, but with a critical twist. The smart money isn't just buying the shovels, the chips. They are buying the land, the water rights, and the oxygen supply for the entire gold rush. They are making a hard asset bet that the ultimate source of profit will be the kilowatt, not the AI algorithm. Third is the powerful historical correlation. The market is giving us a perfect historical roadmap, and it is rhyming chillingly with the dot-com bubble of 1999 to 2000. During that period, the public was infatuated with internet application companies. The psychology was driven by metrics like eyeballs and clicks. They bid up the stocks of companies like Pets.com and Webvan, believing in a new paradigm where profits didn't matter. Most of those companies went to zero. But the lasting generational fortunes were made by those who invested in the physical, boring build-out of the internet. They bought Cisco, which made the network routers and switches. They bought Corning, which had a near monopoly on fiber optic cable. They bought Qualcomm, which owned the essential patents for the mobile network. They understood that every digital revolution is preceded by a physical, industrial one. Today, the psychology is identical. The CNN Fear and Greed Index, which measures market sentiment, has been pegged in extreme greed for months, driven almost entirely by the Magnificent Seven. The public is chasing AI application stocks. The smart money, meanwhile, is quietly accumulating the Ciscos of this revolution: the utility companies, the pipeline operators, the transformer manufacturers, and the uranium miners. This brings us to the most important part, the so what? How does this macro-level shift directly impact your personal wealth, your 401k, your entire financial future? The impact is both a severe risk and a monumental opportunity. The risk is severe and deeply misunderstood. If your portfolio is heavily concentrated in the popular mega-cap tech stocks, you are not diversified. You have made a single, concentrated bet on the stability and capacity of the American power grid. Let me paint a very specific picture for you. Imagine it's July 2026 and it's earnings season. Amazon reports a fantastic quarter for AWS cloud services. The stock pops 5% in after-hours trading. But then on the conference call, the CFO says, and I quote, an imagined but highly plausible statement, "Due to unforeseen constraints in securing adequate power connections from local utilities in the Texas and Georgia markets, we are forced to revise our full-year capital expenditure downwards and delay the launch of 3 new hyperscale data centers. As a result, we are lowering our growth forecast for AWS from 30% to 20% for the next fiscal year." What happens to a stock priced for perpetual, exponential growth when it collides with a hard physical limit? The valuation multiple will compress violently. Analysts will rush to downgrade the stock, and the share price could fall 15–20% in a single day. Because the entire S&P 500's performance is now dominated by these few names, this single point of failure could trigger a market-wide correction. The fear you should feel is that your portfolio's foundation is far more fragile than you believe. But for every risk, there is an opportunity. To be objective and maintain authority, we must consider the counter-argument. What is the bear case for this energy thesis? The most potent risk is a deep global recession. A sharp economic downturn would cause corporations to slash spending, putting the AI build-out on hold and temporarily destroying demand for electricity. Another more remote risk is a black swan technological event, like a viable breakthrough in nuclear fusion from a company like Commonwealth Fusion Systems, or a revolutionary battery technology that solves long-duration storage cheaply. While these risks exist, they appear to be low-probability events in the required time frame. Fusion remains decades away from commercial scale, and even a severe recession would likely only delay, not eliminate, this fundamental supply-demand imbalance. The mathematical certainty laid out in the utility company's own public documents seems to be the highest probability scenario. This leads us to the solution, the actionable plan. This is how you transform this knowledge from a source of anxiety into a strategy for wealth creation. We will rotate from the crowded trade to the essential trade. Here are the 3 specific sectors poised to become the infrastructure titans of the AI era. First, the nuclear renaissance. Nuclear is the only carbon-free power source that can run 24/7, providing the baseload power data centers need. Public and political opinion has shifted dramatically out of necessity, codified by things like the nuclear production tax credits in the Inflation Reduction Act. You can invest in this theme in 2 ways. First, the fuel, uranium. With a structural supply deficit confirmed by major producers like Cameco in their quarterly reports, owning a basket of uranium miners through an ETF, like the Sprott Uranium Miners ETF, URNM, is a direct play on the rising cost of nuclear fuel. Second, the operators and technology. Established operators like Constellation Energy, which runs the largest nuclear fleet in the U.S., are now being valued as growth companies. And for the technology side, look at small modular reactors, SMRs. Companies like NuScale Power SMR are at the forefront of designing factory-built next-generation reactors that can be deployed specifically to power data center campuses. This represents the high-growth venture side of the nuclear trade. Second, the natural gas bridge. The long-term solution may be nuclear, but the next decade will be bridged by natural gas. It's reliable, dispatchable, and abundant in the U.S. The most strategic way to play this is not by gambling on the volatile price of gas itself, but by owning the toll roads, the midstream pipeline companies. These companies, such as Enterprise Products Partners, EPD, or Williams Companies, own the physical pipes and storage facilities that form the backbone of the American energy system. They are paid fees based on the volume of gas they transport, largely insulating them from commodity price swings. Their financial statements show stable, predictable cash flows and often high dividend yields. Their valuations, which have been stagnant for years, do not yet reflect their new role as a critical component of AI infrastructure. Third, the grid modernization plays. This is the most direct picks and shovels strategy of all. Our grid is ancient and must be rebuilt. This has created a secular, multi-decade bull market for the industrial companies that make the actual hardware. You can look at Eaton ETN, a global leader in electrical equipment, specifically transformers and switchgear, which are currently in critical shortage as documented by the Department of Energy. You can look at Quanta Services, which is essentially the construction and engineering firm for the energy grid. They have the skilled labor that physically builds and maintains the power lines. And you can look at raw material providers. Electrification is impossible without copper. Companies like Freeport-McMoRan, FCX, are a direct play on the massive new demand for copper needed for new transmission lines, transformers, and data center wiring. These are the boring industrial champions that will be the primary beneficiaries of the trillions in new grid investment. In conclusion, the key watch list for the coming months is straightforward. Pay close attention to the quarterly earnings calls of major utilities like Southern Company and Dominion Energy. The key word is load growth. Track the spot price of uranium as a leading indicator of institutional interest. And most importantly, follow the capital expenditure announcements from Microsoft, Google, and Amazon to see where the power bottlenecks are most acute. The great story of the last decade was about bits and bytes. The great story of the next decade will be about copper, steel, and megawatts. The AI revolution is real, but it will be built on a foundation of industrial might. You are now at a critical information advantage. The question is, will you act on it? This is not financial advice. It is an educational framework to empower your own research. And so the final question is for you. Are you positioned for a world where the power plug is more valuable than the AI algorithm? Let me know your thesis in the comments below.